We're going to pick up chapter 3 here with transaction G, and we paid a phone bill. So we had phone service for $100. Well, we paid it, so that suggests that we had to use probably cash to pay for it. And what is a phone service? Well, it's going to be an operating expense. So we've got cash and a new account called phone expense that are impacted by this transaction. So now, where do these accounts live on the balance sheet equation? Hopefully by now you know cash is an asset, phone expense lives on the within the owner's equity umbrella, and then what happened in these accounts. So we have less cash. Our cash went down as a result of paying our bill, and we had an increase in phone expense that we're going to record. And we know that that cash goes down with a credit entry, and we know that phone expense goes up with a debit entry. And here is our T account. So we'll start with the cash. Again, we see that cash has gone down. I wish it sort of had all our prior transactions in here, but unfortunately I think it would get too unwieldy after a while. So we're just going to start with what was the prior balance after the last transaction. We see it go down by $100, and our assets are at $7,200. Now, over on the right side of the equal sign, we see within our expense section this phone expense, and our phone expenses went up as a result of having incurred this cost. And now when we tally up our owner's equity, we get $6,000 added to our liability that's still hanging out, $7,200, and we are in balance. Mitch made deliveries on account for $2,400. So again, the words on account ought to jump off the page at you at this point, because what it doesn't say is cash. So what that tells me is that Mitch did some work and Mitch didn't get paid. I know how that feels sometimes. Happens from time to time in my law practice. So Mitch made deliveries. He's in the business of delivering things, so that's going to be a revenue, probably delivery fees, and on account. So we've got delivery fees and accounts receivable. Now this might look a lot like an account that you saw in an earlier transaction when we owed some money. And I think this is something that students tend to confuse pretty quickly, and for a long time, actually, I should say, is the difference between accounts receivable and accounts payable. Accounts payable is what happened when we owed money for those scooters that we didn't pay for, and that's a liability. And the opposite is true when there's an accounts receivable. So an accounts receivable is when somebody owes us money and needs to pay us, and that lives on the asset side of the equation. And if you can think about accounts receivable as something we are entitled to receive versus accounts payable, which is something we owe, and try and keep those separate in terms of accounts receivable being an asset, accounts payable being a liability, hopefully that will make it easier going forward to remember the difference between those. So our accounts receivable is an asset and our delivery fees is revenue. So we had an increase in delivery fees and an increase in our accounts receivable. Again, accounts receivable is an asset, and we know that when our assets go up, that's a debit. When our delivery fees or revenue go up, credit entries do that. And so let's see, and this might be getting all kind of monotonous for you at this point. I apologize if it is, but the review can be good. So here we are on the asset side. We have a brandy new accounts receivable account, and that's a debit because we're now showing that people owe us some money. On the delivery fees side, we earned some more money. So we have earned a total of $4,500. We have incurred expenses of $1,100, and we still have our owner's equity. So our owner's equity amounts to $8,400. If we add that to our accounts payable under the liability side, we have total on the right of the equal sign of $9,600. On the left hand of the equal sign, our assets total $9,600. We are in balance. We can move forward. So now we're going to purchase supplies. And something important to highlight here that can be confusing. If this is going to be something that is going to benefit us for more than 1 month, we're going to have some future benefit, we're going to treat something like this supplies as an asset. If, on the other hand, it's going to be something that we're going to buy and use up immediately. Let's see. Perhaps I just needed some Post-its because I was going to do a project and I needed to tag a bunch of pages. So I run over, I buy these Post-its, and I know I'm going to use all these Post-its within the month. I'm probably going to do an expense right away for those. But if, on the other hand, I'm doing a massive office supply order and I'm going to be ordering supplies that I know are going to last me for a while, so that I don't have to do an order anytime soon, I'm going to record that as a supply. So here we have cash because we paid cash, and supplies, and we're going to treat the supplies, oh, supplies is not revenue. This is a terrible mistake. So supplies is an asset, not revenue. And shame on your book publisher for doing this and why I didn't notice it before. But anyway, so we are going to debit supplies because we now, supplies being an asset, ignore what this says on the slide. And a debit means the balance in our asset account has gone up and we do have supplies. Meanwhile, we're going to credit our cash to reduce cash by what we paid for those supplies. So now let's see how this plays out. We've got our new account for supplies here. We've got our same old cash account. Our cash account has now been credited to address the money we've paid, and our supplies account has been debited to account for the increase in supplies. And it doesn't change our total asset picture from the last time because all we have done is shift the nature of our assets. We've turned $80 of cash into $80 in supplies. Nothing happens on the right side of the equal sign, so we remain in balance. Now we've got cash receipts from prior sales. Mitch received $1,900 in cash for delivery services performed for customers earlier this month. So way back when he performed services on account, we recorded an accounts receivable. Now Mitch is being paid for those services. We have already recorded the services, so we don't want to record them twice. We only record the services once. Otherwise, if we recorded the service at the time we performed the service and at the time we paid for the service, we would be double counting our revenue. Okay, so what we have is cash that's being impacted because remember when we recorded that revenue, we recorded the accounts receivable, but now we're getting the cash. But because we're getting cash, these people are now going to owe us less money than they did before because they're paying off some of what they owe us. So let's look. Oh, again. So these are both on the asset side of the equation, and our cash will go up as a result of having been paid that cash. And the balance in our accounts receivable, since these people now owe us less money, that balance is going to go down. And because they're both assets and the debit will make the cash go up, the credit will make the accounts receivable go down. And so let's just take a look, and lo and behold, that is true. So here is the cash that we've been paid, and our cash balance goes up as a result. But meanwhile, we're now owed less money, and so that balance is going to go down with that credit, and now it's going to show that they only owe us $500 as a result of having paid the $1,900. It doesn't change our overall asset picture, and nothing on the right side of the equal sign is impacted. So now we are going to purchase an asset on credit, and we're going to make a partial payment. So Mitch has got now a third motor scooter that he buys for $1,000. His motor scooters seem to be getting cheaper as they go. Anyway, so Mitch is going to make a down payment of $300, and he's going to spread the remaining over the next 4 months. So think about the accounts that are involved. Now, we've bought scooters twice before. The first time we paid all cash, the second time we paid no cash and we owed the money as an accounts payable. This time we've got a little of both. So it's not just one account, or it's not just the two normal accounts that are being impacted, but we're going to have 3. And those are the delivery equipment, obviously, because we've now got a new scooter, the cash to cover the down payment, and the accounts payable, because we're going to have a new debt as a result. So how is that going to look? We're going to have a debit for our delivery equipment. That's an asset, and it's going to go up by the $1,000. Even though we haven't paid for all of it, we're going to debit the full value of the scooter. Meanwhile, our cash balance has gone down by the $300 down payment, and we owe the balance of what we owe people will now go up by $700 as a result of this new debt. And so let's see how this looks. Now, for the first time in a while, we see some movement on the liability side, and our liabilities have gone up because we have a new $7,000 debt, bringing our total liabilities to $1,900. Now over here on the left side of the equal sign, on the asset side, we see a credit to cash for the down payment, which reduces our cash balance. And then we see the debit for the full price of the equipment, regardless of the fact that we haven't actually paid for all of it. And so between these 3 entries, our balance sheet equation remains true. And so now we've got Mitch paying $700 for an 8-month liability insurance policy. Now, for those of you who pay for insurance, if you pay, let's say, a year's worth of car insurance, and 2 weeks into your car insurance policy, you decide you don't like your car anymore, you're going to sell it, you don't want a car, it's a hassle. Okay, so you sell your car. Well, you already paid for a year's worth of insurance. Does the insurance company get to keep all of your insurance money? No, you haven't actually used it yet. So the insurance company will refund to you the portion of the money that you haven't used up of that policy. So they get to keep what you used up during the time period you had the car. Same is true of Mitch here. If Mitch decides he's going to go out of business after a month, and he bought an 8-month policy, they're going to owe him 7 months of insurance back. So because he can get that money back, we consider that $700 an asset until we've used it all up, which we'll worry about in future chapters. And we've paid for this in cash. So we've got our cash that's being impacted, and now we have a new account called prepaid insurance, which is an asset. And again, why is it an asset? Because if he cancels the policy tomorrow, he gets his money back, and he would get it back in the form of cash, and that's an asset as well. So our prepaid insurance account goes up by $700, and our cash is decreased by $700. So we debit prepaid insurance for $700, and we credit cash for $700. And here again, everything occurring on the asset side of the equal sign. So all we've done is we've decreased our cash, we've increased our prepaid insurance, and we have a total asset balance of $10,300. We have done nothing on the right side of the equal sign. Now we're going to pay some folks. I don't think Mitch pays very well, but anyway, Mitch paid his part-time employees $1,650 in wages. Now this is going to be an overly simplified example of paying wages. When we get into the payroll in later chapters, this will get much more complicated, but for the purposes of illustration, we're just going to keep it very, very simple. So we've got wages expense. You could call this salaries expense, payroll expense, whatever, but in this case, we've chosen to call it wages expense, which again is an expense. And what did we pay them with? We paid them with cash, which is an asset. Do we have more cash? Do we have less cash? We have less cash. So cash decreases by $1,650 and the expense that we've incurred for wages goes up. And we know that we debit our wage expense for $1,650 and we're going to credit cash for the same amount. And here is this in asset or T account form. We see the credit to cash, which reduces our assets as well as the cash balance itself. And over here within the owner's equity umbrella, you see we've added yet one more expense to the expense column, and that is a debit. Our expenses have gone up by $1,650, and so again we've got our $5,000 in equity, we have our delivery fees, those are credits, and we subtract the expenses from the credits and we get a balance of $6,750. Adding our liability to that, we see that the right side of our equal sign is $8,650, which matches the left. We are in balance, we can move forward. So now we've got deliveries that are made on cash and credit. Remember that before we did deliveries where they were all in cash and deliveries all on credit. This time we've got a mix. So as you can probably guess, we're going to have more than two accounts that we're going to be impacted by this transaction. So we're going to record all of the delivery fees, whether or not we're paid for them. So we're going to have our delivery fees account that is impacted, and then we've got cash, and we've got accounts receivable. People owe us, so it's a receivable. And so we've increased our revenue. We've earned $3,500 more, of which our cash went up by the $900 we collected, and our accounts receivable went up by the $2,600 that people still owe us. And so we've got credit delivery fees, debit cash, debit accounts receivable. And so you will see we've got our debit to cash, our debit to accounts receivable, which increases our total asset picture to $12,150. Over here on the right side of the equal sign, you'll see that our delivery fees have gone up. We now have earned a total of $8,000 in this accounting period. And when we subtract the expenses and add our owner's equity credit, that has our owner's equity sitting at $10,250 under the equity umbrella, and then added to that the liabilities. The right side of our equal sign is $12,150, which matches the left. And I promise we're coming to the end of this. So now Mitch has clearly decided he wants some money out of this business. So he's going to take $3,000 out of this business. Well, what is he going to take it in? He's going to take it in cash. So pretty obvious at this point that our cash is going to go down by $3,000 as a result of Mitch taking this money out. Now, what account do we deal with on the equity side of things as a result of this? So we're not going to take it out of Mitch's capital account. Instead, we're going to report that in what's called the drawing account or the owner's draw account. And so we're going to credit cash because our cash goes down by that $3,000. And we're going to debit Mitchell Williams drawing for $3,000. And let's take a look at our T account so we can see. So now we've got this draw account over here. Again, we're still under the owner's equity umbrella. And we see that when we draw money, now you might be thinking to yourself, well, but the company is losing money. How come the draw goes up, not down? And the answer is we're keeping a tally of what Mitchell has taken from this business, and that tally has now gone up. So we're keeping a running total, and this is the first entry on our running total, and we want to, again, keep track of all that Mitchell has taken from this business during the accounting period. And we see our credit to cash, and I won't go through all of the details here, but we remain in balance. And I think this is the last transaction. Nope, that was the last transaction. Okay, so again, at the end of, we're now down to transaction O. I have no idea how many that is, but we see that he's got still his $5,000 in equity remains intact. That's actually offset by the fact that he's taken $3,000 out of the business in the form of a draw, and our delivery fees are reduced by our expenses, and so our total owner's equity is $7,250, and because basically the net income is attributed to owner's equity, the difference between the fees and the expenses. And then we've got our lowly liabilities over here and our assets. And so we're going to move on to the next video for what happens here.